What's up, investing legends? Today we welcome Tene Williams to the program. Tene's investing journey started long before most people even think about investing. Stepping into the world of finance as a teenager and getting her securities license by 19 while already supporting a family. It was real-world pressure that shaped her mindset early, forcing her to learn money, business, and investing principles in real time, not from theory, but from necessity. Today, Tene is a fund manager and capital allocator, operating a private equity fund that invests across real estate and multiple alternative asset classes, applying a diversified income-focused strategy designed to perform across market cycles. We kick off the episode today with Tene's origin story and how her early experiences in finance and real estate, from bird-dogging residential deals to running a vertically integrated operation, shaped her approach to investing. Later on in the episode, we dive into the evolution of her strategy, why she transitioned away from traditional value-add and development plays, and how she now focuses on buying income through cash-flowing assets while avoiding the risks that wipe out less experienced investors. And to wrap up, Tene shares her perspective on navigating market cycles, where she sees opportunity emerging today, and how investors can position themselves to not just survive downturns, but capitalize on them. So if you're looking for frameworks to build durable wealth through real estate and private markets while learning how to think like an allocator across cycles, this episode delivers perspective from someone who's lived and learned many lessons through multiple market cycles and continues to deploy capital with a disciplined, income-first approach. So without further ado, everyone, let's welcome to the show, Tene Williams.
Welcome to the Investing Secrets Podcast.
Tene, welcome to the vault.
I'm excited to be here. Thank you so much for having me.
Yeah, no, I'm excited to have you here. And your background is very interesting. I read here that you got into finance and had your securities license by the time that you were 19, which is really young. I would say for anybody to be getting their securities license. So I'm just wondering, like, what inspired you, right? Like, so at such a young age to pursue a career in finance?
Well, it's funny because my first company, 19 for me, I was already a grown woman. So I had my first son at 16 and my second son at 19. I was in college and it's just like, and I had already moved out of my mother's home. So I had already by that time been actually shot in New York City. I was shot at 17.
Shot by like a gun?
And in the chest with a gun, 38 revolver, close range by accident, which led me to actually end up, I know. So that's what led me to have to move out of New York City. And when you think of me as a 19-year-old, I was a pretty grown woman with an apartment already and, car, doing bills. Like, so I applied for a position someone pitched me, with Primerica Financial Services. I think it was like in a line at a supermarket, and they pitched me Primerica Financial Services, which I don't know if you know, is an insurance company. At that time, It was Smith Barney. So pretty awesome. And that just opened my eyes really to the rest of my life.
Interesting. Yeah, we all grow up at different speeds, so it sounds like you got kind of thrust into that and put you on a fast track. So I'm wondering though, because Tene, obviously you started in finance, but eventually found your way into real estate. I know now you do a little bit of raising for businesses and do perhaps some VC stuff as well. But when did the kind of like impetus, or where was that inspiration to start investing in real estate?
That's a great question. And the reason why I started investing in real estate is because of Primerica Financial Services. So when you're sitting at that kitchen table and you're going through all of, someone's finances. One of those things was debt consolidation and looking at their home and looking at, their entire financial picture. So very early on, that made me realize and to pay attention to the infomercials. And I know I'm dating myself because I'm telling you about infomercials that came on in the middle of the night, okay, at 2 a.m. And those, Carlton Sheets and, some of these guys, I started to go to hotel meetings, and I'd go because they'd offer a free weekend, so I'd go to the free event. So I didn't have the money for the upgrade. But of course, you don't know they're going to try and sell you an upgrade when you go to the free event.
Of course.
So,
of course.
That got me into the whole community of real estate, though, because now I just started to join the local investor clubs, and these investors would say, hey, go out there and, find us an ugly house and we'll pay you $500 for it. So that's how it all started, being a bird dog. I think I've done everything under the sun from the very beginning. So everything that everyone talks about these days, like, oh yeah, I'm a wholesaler. I'm a this, I'm a that. And I'm like, yeah, been there, done that long. You guys just renamed it. But being a bird dog, it's literally meant just go find an ugly house, overgrown grass, and then you don't even know how to evaluate it or anything. Bring it back to the investor club and someone will say, oh yeah, this looks good. And, if they get it under contract, then that's $500. So, learned how to do that very well. And it's funny because with me, it's always like, oh, that's nice. So you're only paying me $500, but you're probably making thousands. So how do I do the next thing, which is wholesaling, actually getting the contract and negotiating with the seller and then selling that contract. So, and it's been escalating over the years. And it's always because someone said, I'm doing one part of the transaction. I see the other guy and I think the other guy's position is so much better than mine. So then I want to figure out how to do that too. And that's pretty much my journey. Like that's the story of my entire journey.
Well, I think there's something to be said for someone who has experienced every phase, and kind of built up from the ground, right? And kind of like taking their licks through every phase of the game. I think there's some people who, either through connections or through degrees or through whatever, they find themselves and they kind of come into the game, but they're positioned at a certain level. But I think there's something to be said for understanding and having played in the weeds before playing in the tall grass, right? And there's I think that there's an element that's irreplaceable. There's a certain level of experience that's irreplaceable when you've kind of gone through.
I completely
from the ground up. Yeah. No, and so
I completely agree.
What's
there's so many people there's so many people that I meet that are like just getting started and they're trying to start at the institutional multifamily stage. And I'm just like, and they have no idea how to even find a deal, find a seller. Let's say they're coming to me and they're like, oh yeah, I want to do acquisitions, or let's just keep it small. Let's just keep it on a single family level. There's so many people that are on Facebook or some of these platforms and they're like sending someone else's deal to you and they did no work at all to know who the seller is, know any of the comps, know any of the rehab numbers. And it just baffles me. So you're absolutely right because, it's not as easy as it looks.
It's not. And I also believe that there are skill sets that you can build over time that, because, my background was in residential before I started working in hospitality. And that has served me well. And there are ways that I think about things that guys that don't have my background, don't think about things, right? So it gives you different perspective. Not to say that there's not to say that the other way is the wrong way, right? But it does provide you with certain advantages, I think, or certain perspectives, ways of thinking of things and framing things that maybe others don't necessarily have because of their background, right? So very cool. I'm wondering though, at some point today, you started kind of working more as like an allocator, capital allocator through your fund of funds model, and walk me through the transition there, right? And because you went from like flipping and then operating to being more of an allocator, and I'm curious, when that switch happened and what inspired that transition.
It's literally what you were just talking about. It's literally all about the journey, and the journey of having gone through 4 cycles of real estate, having gone through, not just real estate. It's so funny because I got into finance as a result of real estate, where most people, kind of come from a different view. So I knew how to get hard money loans before I knew how to get, an FHA loan or anything like that. And something switched for me. I think it was in 2000 between 99 and 2000, I says, I need to learn how to do conventional financing. So, and the reason why I wanted to learn that is because I wanted to get better terms on my deals. So, and at that time, I read the book by T. Harv Eker, How to Be a Millionaire. And that particular book says, if you want to be a baker, go work. If you want to open a bakery, go work for a baker. So in my mind, I said, okay, I want to understand lending. So let me go work for a mortgage brokerage. And so I went to work at that mortgage brokerage. Within 6 months, I'm a fast learner. I left that company. I was doing $8,000 to $10,000 a month. And this is in Las Vegas. It was a hot, wonderful time, not just hot in heat, but hot in the market. The market, there were like 6,000 people moving into Vegas every month and 4,000 people moving out. Toll Brothers and KB Homes and a lot of Hortons, all of these companies were building like insane, and the lending space was insane, because I'll never forget one of the loans that I did for a lady. She was Persian, from Chicago. She had moved to Las Vegas. She wanted a no income, no asset loan, which was one of those loans you could do back then. I don't think they even have them anymore. And at 95% loan to value. So she bought a brand new custom home. Yeah, she bought a custom home, 95% finance. She put 5% down. And what was insane is 2 months later, she came back and refinanced and got her 5% out, because the new phase of the homes were already selling at about $150,000 more than the house she bought 2 months prior. That's a hot market. So that's a really hot market. So that was the market that I really got my feet wet in finance at the very beginning. And just, opened my own shop, my own brokerage. And then by 2005, by 2004, the market crashed, and it wasn't hot anymore. And I became, but I was also pregnant with my last baby. I have 3. My sons are 36, 33, and the last one is now 20. So really proud of them. But I was pregnant with the last one, and I said, okay, I'm going to close this shop. It was very difficult. It was horrible that I had to close. I moved back to New York City. But before I did that, I became an account executive, inside account executive for some of the mortgage banks, because the way it works, back then and up until 2008, there were account executives that worked for each bank. And, and these are like subprime mortgage banks. So they work for the bank. They'll come into your office and say, hey, these are our loan products, send us deals. And so I became a AE for several of the mortgage banks. And actually one of them were Merrill Lynch had bought one of those mortgage banks called First Franklin Financial. And it was just great. So on the back end, I'm, still doing rehabs. I've got lease option to buys. I've got rentals on the residential, and then I'm making money on the finance side. And again, everything was great until 2008 hit, and, we lost a bunch. I had everything invested in mortgage-backed securities, and I was in real estate, and we had rehabs going, we had this and that going. But what I did at that point, and this is getting to the point of the question you asked about how do you go from that to this? I'm telling you.
I'm listening. I love it. I love it. Keep it coming.
So what happened is that we went, I learned how to, because we also had a construction company at that time. So somewhere between 06 and 08, we launched also a construction company. So we were vertically integrated. We were doing our own deals. We had the construction company. I had, I was getting everything financed with business loans. And so because I did so much for my own company, as a comeback after everything crashed, I started my own consulting company, funding everyone with corporate loans. So we would fund our rehabs with business loans, $50K, $100K, because there were no more hard money lenders. So all the hard money lenders were like out of the market, not doing deals around like 2009. So that was the way we were able to keep it going, keep deals going until that dried up. So, you just get into these cycles, and fast forward, I came back around 2014. When I say come back, I stayed in the finance and, doing small business loans and all of that until around 14 before I had the guts to start looking at real estate again, because none of the banks were funding anything. If you said you were a real estate investor, as far as I'm concerned, all my circle of influence, it was like a bad word. It was a very, very bad word.
Yeah.
So 2014, I started to buy. I says, okay, we're going to buy like 2 to 4 family properties. And I'm in New York at this point. So there were amazing deals in New Jersey. I bought several duplex, triplex, fourplex properties between New York and New Jersey at a super crazy discount. Like we're buying these things at $70,000, $80,000. And the previous cycle, these same properties were $150,000, $200,000. So we know we're getting a deal. And then they're rehabs. So I know I'm buying below market value. So I go, okay, there's no way I can lose now. There's no way I can lose. I'm way below 65% of the value of the property, and there's no way. And then we get hit with COVID. And then the government said, oh, all your tenants, they don't have to pay. Don't worry about it. But the mortgage companies wanted their money.
About it. Yeah. We're worried about it. Yeah, you have to worry about it. Yeah,
the mortgage companies wanted their money. So that's why I finally, 21, I said, you know what? I got to go bigger, because the pain that I kept feeling in getting hit and getting pushed back after you just did all this work and you think you got it figured out, then there's a market cycle. There's a change. Something happens. The financial, the hard money lenders are not there. This loan is not there. All of these different changes that are consistent. And when you are out here long enough, you see that these cycles are so normal. you just have to figure out how to get above it. So, I thought more doors. I need more doors. And I went to find a coach that, would teach how to buy like a 20 unit. And that coach, actually as a result of that coach, I saw that 20 to 50 units wasn't the sweet spot. The sweet spot was 100 doors or better. And the only way I could do that is if I syndicate and launch a private equity fund. And so we launched the fund in 22, and was a small $25 million fund. We were able to turn the first allocation. We raised 20 million of the 25 million. And that all went alongside other operators, other GPs that are much larger than us. And we invested alongside them and turned that 20 million into 300 million in assets under management.
Wow.
So that's the long
That's awesome
story.
Yeah.
But the real end to the story, though, is because of all of that diversity that I had to deal with in all of these market cycles, being an entrepreneur, I learned from Ray Dalio. Ray Dalio's holy grail of investing strategy. He says basically you need about 15 different bets. Uncorrelated bets. And so 20% of the fund is M&A. So now we're raising that last $5 million and we're investing alongside operators that are experienced already doing roll-ups. And now finally, we're completely agnostic so that our fund can have, all of these other verticals. So if real estate has another hiccup, we're in healthcare, we're in concrete, we're in this, we're in that, so that's the strategy. It's like a mini KKR.
That's really great. But what book is that? What Ray Dalio book is that? Is that the famous one, the one that the big one that he wrote?
So he just came out with his book Principles.
Okay, I think that's the one that I know
Principles.
about. Yeah. Okay. Yeah. Okay.
However, what's interesting is Tony Robbins. Yeah, Tony Robbins wrote the book called The Holy Grail of Investing by getting permission from Ray Dalio to use that name. So he just came out with that book.
Oh, cool. He just did. Tony
but
Robbins
Ray
did.
talks about it.
I'll have to check it out.
Yeah, he talks about it all the time. Like if you go to any of Ray Dalio, like that's his thing. Uncorrelated. 15 uncorrelated investments so that you can survive.
Interesting. Very, very interesting. Wow. Yeah, that's great. So coming back to the investment strategy of the fund, it sounds like you primarily at the beginning were focused on real estate through that fund of funds. Now, are these allocations today? Like, are you typically coming in? Like, what's the usual strategy? Like, what are the when you're analyzing a deal? What are the things that you're looking for, and where do you like to sit in the capital stack? Kind of like walk them through the just like the nuts and bolts of the investment thesis.
Well, the whole thing, I coined the phrase buy income. So you'll see it on all of our stuff. It's the buy income strategy. We only like cash flowing opportunities because we are buying income for our investors. And like I said, so when people come to me about a development or they come to me about, this rehab project, I have pain from those things. So I don't want to, there's so many variables that happen in any kind of rehab, any kind of construction deal, any kind of development. And of course, there are experts in that space that can erect a building in 3 months. However, my experience has been pain and heartache. So there's so many variables that happen in the permitting process and the this, the that, or if someone comes to me about a startup and they say, hey, we started this company, blah, blah, blah. And I'll give you an example. The first company we put $100K into, that company I thought was cash flowing, and we haven't seen a dime from that company. And then, come to find out it was seed capital, and he's not even fully launched, and none of the contracts that he had, are moving forward. And so it was just like, oh no. So now, even on the M&A side, not now, but on the M&A side, we are only looking for businesses that have net operating income. And it's funny because I even had someone come to me and say, okay, well, yeah, this company has net operating income and is cash flowing, but your investors are not going to see any income from it because we're going to keep reinvesting, and there won't be any money for, 5 years or whatever. And I said, that's nice.
Yeah.
Not for us. So,
right.
So everything has to be cash flowing. And when we first started, the trend that even the coach that I was with taught was to buy Class C multifamily apartments in tertiary markets, and in tertiary Class B areas. So you buy Class C building, which means the building is going to be like maybe the year it was built was 1970s through 1980, early 80s. So that building has a lot of rehab potential, and then you fix it up and increase rents. We did that for the first property we acquired in North Carolina, and it's a success. But many of the colleagues that I know, as 22, 23 is happening, what happened. The interest rates were super low. So people were getting in at their rate was like 4%. And then they thought in 3 to 5 years, which would be now, they were going to sell for, a 5 cap or, a 4 or 5 cap. Yep. But it didn't happen. It didn't happen that way because the rates are too high. So I saw that trend by 23 and said, no more Class C. I don't want to see Class C at all. It's too risky. And we said, okay, we're going to go after these distressed sellers that have Class A value add properties that are 2015 or better. So that's why our portfolio has, out of the 800 doors, we've got 3 properties that were built in 22, 23, and even 20. One of them in 24. No, 22, 23. And then we had one that was going to be 24, one that we're going to close. But yeah, brand new properties where the developer just needs to get out and fully occupied. And then we're finding an arbitrage in affordable housing.
Interesting. What do you mean by that? Affordable housing that's Class A?
Yeah.
How does that work?
Do you do that? Well, let me tell you what happened on 2 of the properties. One of the property is in Decatur, Georgia. That property, Avondale Hills Apartments, we got, it was built in 23. And that property, basically, we were able to get a tax credit for affordable housing in Decatur. And then the Florida, we closed on Pure Vita Hialeah in at the beginning of last year, January of last year, that property was at 260 doors, but 75% of the property taxes are abated. So there are 75% less property taxes. So we have that tax abatement because of something called the Live Local Act in Florida. So there's these little strategic wins that you can get that's not always about raising rent.
Mm-hmm. The tax credits. So basically you converted or took an existing Class A building, made arrangements basically with the city to turn these into affordable units and got a tax credit for it. So is the tax credit a lump sum payment, or is it spread out over a certain number of years? Is it tax rebates? Like, how are they structured? Is it like a lump sum up front or a combination of all those things?
It's a tax abatement. So of the taxes, so let's say if the tax is 100,000, we're only going to pay 25,000. And so we didn't have to turn it into anything. That is just how the Live Local Act works because of the AMI in the area, which is the income in that particular area of Hialeah.
I see.
And the previous person
owner didn't know about this. And the previous owner didn't know about
it was actually, they did. It was part of our acquisition. The owner was a developer. So with most of these Class A's, we're getting it directly from the developer that built it.
I see. It's a merchant builder.
So this developer needed to build and sell. And they built and sold at just a different time in the cycle. So it is a buyer's market, not a seller's market. So we required that particular seller, we wouldn't close until Live Local was approved on that deal. And, then we were able to get it. So it's, there's so many strategies that you could use in multifamily, to increase revenue and, increase the profits. And see a nice 18 to 22% IRR without actually counting on raising rents 3% every year. That was the strategy that we learned to do from our coach. And that's the, typical thing that everyone talks about. But you've got to be a pioneer out here, and that comes, I think, from my experience of having gone through a few cycles. You just have to understand the down cycle's coming, the up cycle's coming.
Yeah. And how have you, so from all the lessons that you've learned, right, tonight, because obviously you've learned a lot of lessons, how have you positioned the fund that you're running now to weather and or take advantage of these cycles, right, as opposed to getting crushed by the cycle or the change in cycles? So what are the things that you've done? It sounds like one of them, just to answer my own question, is to diversify within the fund, right? With different asset classes and different sectors altogether, right? Like, hey, we're doing M&A work and doing it across a myriad of sectors even within that. So it sounds like that's diversification is number one. What are the other things that you're doing now?
That's a great question. So we are using AI to capitalize on some of the trends. We stay very focused on net migration. We stay very focused on where the opportunities are. Like, for instance, when we first launched the fund, it was all about the Sun Belt. Lately, we've seen that there's great opportunities in places like North Dakota and Minnesota, Wisconsin, and, before, my main thing, because of the pain I felt not getting paid from COVID, I wanted to be in landlord-friendly states. So, there's things like that. And then there's also credits for certain specific tax credits that you can get because we're buying properties from developers. So we're able to find an arbitrage there with not just property tax credits. Let's see, what else? What am I forgetting to say? I'm trying to think of what I haven't said.
I just put you on the spot. That's
yeah. I think it's pretty much been all about AI, and then we look at solar. We look at how can we take this building, maybe do a green roof and do solar on it. There's also another thing that we're doing where with the not long distance, but cell towers. So with the cell towers on the contracts, we're able to see if there's already contracts, and if there's not, there's new contracts that we can get when we strategically buy in areas that don't have a cell tower on it, or it could use more 5G cell towers. And so we're able to use the building in that way and increase revenue. So
yes.
Is that a strategy you're familiar with?
I've heard that being a very, I've heard of that being very lucrative. And know several, especially I think that's especially common. Well, could be common with all sorts of commercial real estate, but I know retail especially uses that a lot. Hospitality, like lodging,
Tesla,
hotel,
Also, Tesla power stations. So Tesla power stations is something we're looking at for one of the properties, to put the Tesla power station there, and then we make additional income there. So, there's just a lot of strategies. But again, we're not the operators. We do spend time researching, and we're collaborating on that. And then we're hiring property manager. So if we're collaborating with another, like let's say someone else bought their deal to us, that's really in their wheelhouse.
Right.
Like Pure Vita was bought to us by someone else. We invested $5 million into Pure Vita, but there was a $30 million raise on Pure Vita. So, that was a $95 million acquisition. We have a little small piece. So in general, our piece of most of the properties is like 5 to 20% of the GP. And we're doing all the underwriting as if we are running it. It just depends on the building. It depends on if we found it, our acquisition team found it, then we're wanting that property management to implement our plan. If someone else brings us the deal, then, we don't have that much control, but we pretty much see eye to eye on, some of those ideas. We have some input on it.
Very interesting. Very, very cool. Well, we are running up on time today. But I can't let you leave just yet. We've got a few more questions here for you. Where do you see, obviously you've lived through, and I love that you, got so raw with us today. Just kind of walked us through your backstory. You've been through several cycles right now, which gives you a unique advantage to being able to maybe have a little bit more of a foresight, right, into what the future could hold for us. So what do you see happening here, over the next couple of years? Well, we'll just stick to real estate right now, because obviously you've got other silos that you're focused on. But in the real estate sector specifically, because it's so it's chaotic and there's a lot of uncertainty. So where do you see this all heading?
Buy real estate and wait is not my saying. There is no way you're ever going to go wrong in real estate, because you might make a mistake on the market cycle, but if you understood not to panic and just wait it out, there will be an up cycle. And and this is what lenders know, because we were expecting so many times. We knew, I think the number was oh my goodness, there's $400 trillion in all of these, bridge debt that has to come due. And I've been waiting for it, 23, 24, 25. And what happened is that the lenders kept renewing, especially on the commercial side. It's not the same as on the residential side. So on the commercial side, they kept extending. Now, some of them don't want to extend anymore, but you don't see foreclosures, especially in multifamily, like you see here. So the investor doesn't have to lose all of their money if they're patient with the market cycle. So someone may say, okay, well, we're going to have you out in 3 to 5 years. But then you may get to that third year and it's not the right time it's not an up cycle for you to sell. So your cap rates are not compressed and everyone just has to wait a little longer. So, but then, then now you're negotiating with the lender. Hey, okay, we didn't buy that rate, the rate cap, and a lot of people didn't buy the rate cap. But there is still a way. And so what's happening right now in private equity at the hundreds of $million range, companies like, what is their name? I was just on their website. My God. There's certain private equity funds that are going around and buying out the equity positions of the GPs. So I'm seeing that as a major opportunity right now. So people that, need to get out, there is an opportunity for some of these multifamily operators that have investors that need their money out because they can't meet the mark and get the appreciation that they expected. Their pro forma said, oh, we're going to raise rents 3% every year. And let's say you were in Houston and it's negative rents. So negative rents. Okay. So now you've got a bunch of investors down your throat, right? So what's happening is there's an opportunity for a lot of these multifamily operators who got trained by some of these coaches who said to underwrite that way are able to, just kind of, walk away by selling to private equity. So to some of those larger private equity funds that are gobbling up those opportunities. So there's always an opportunity. It depends on where the opportunity is. But when it comes to housing, everybody needs housing. It's not going to change.
Right. Well, I actually I don't know that I've heard that yet, that certain PE firms are basically, buying discounted shares, sounds like, right? So that's really interesting. Very cool.
That's
well,
right.
Tene, it's been a pleasure having you on. Before I let you go, I can't let you leave the vault without leaving the audience with one final investing secret. Take it away.
Buy income with your earned income. And that's all what I write in my latest book, The Buy Income Strategy. It's all about buying income with your earned income, because with the advent of AI and all of the things that are happening in the market and how change is so constant, I think none of us can wait for retirement before we start enjoying life. So that's one of the things that I like to show people, how they have the opportunity to buy income with their earned income, whether you're a business, whether you're a contractor, whether you're a W-2 wage earner. There is a whole alternative market space like ours, and 27 others that I name in my book, The Buy Income Strategy. So that's what it's all about. Take a specific percentage, larger percentage for today that you can live on. So you're living on your passive income, which has better tax advantages, instead of living on, creating your entire lifestyle on your earned income. And that's something I've learned from a series of teachers. And it's just so relevant right now. I think that's the key. That's the key right there.
I love it. I love it. I could not agree more. Tene, it was a pleasure having you on. If you're interested in connecting with Tene, you want to check out her latest book, all of those links will be in the show notes and in the description down below. Thanks for stopping by today. Best of luck to you.
Thanks for having me. All right, Danny.